What is the future of this rally? Is today perhaps the sign of things to come as we go into earnings season, a kind of a muted market? Or do we see more big gains? Again, 20% of the S&P reports next week.
Yeah, I don't see how we have big gains, but, I've been on that platform for a long time. To me, there's just too much that's potentially weighing on the broader market. It's things like tariff uncertainty, valuations that are already stretched, the consumer is starting to show little signs of cracks. There's a lot out there. I also don't see anything that wildly derails it. So I think within earnings season, we're probably going to have some big booms, some big busts in the individual company level. But I'll bet you that collectively, we kind of come out with a meh. So when we think about this rally, what are we up right now on the year? 6%, 7% for the 7%ish year to date? What if we end there? How wonderful would that be after years of plus 20% in 24 and 23? So that'd be wonderful. So I kind of think of the rally as let's just hope it sustains to this point and that nothing knocks the wind out of the sails. But I just don't see how with 9%ish expected earnings growth, with a 22 times multiple, with all the uncertainties out there, I don't see how we end up 14% on the year. I don't think we have another 7% in the second half.
I want to touch on your first point about the market being, valuations being a bit stretched. S&P right now trading about 22 times. 5-year average is 20. NASDAQ at about 27.5. 5-year average is about 25.5. Weiss, I'm coming over to you. Do you see something derailing this rally? Do you see the markets just moving sideways? Does something lead us to moving lower? Again, we have that August 1st tariff deadline that Jenny was just alluding to. Is that potentially a catalyst for a downside move?
Potentially, but we've seen that will get extended. My bet is it does get extended.
So taco trades in play.
Yeah, but it's also, look, as I mentioned, I spent a lot of time in private markets, and deals never close when you want them to. I think the mistake they made, the administration, was advertising we're going to get this done quickly. Trade deals take take years. So I think you'll see some agreements in principle. I think the positive that could be, you get a major deal with India. There's a word that could be coming. The EU, you hear that also, but that's less likely because so many head of cattle are herd. But that'll push the market up. It is a risk, though. If the administration draws a line in the sand with August 1st, then those tariffs come into effect, and then I think you see the market take some gas. But look, overall, you're coming to a seasonally slow period in September. That tends to get discounted earlier, and people just don't want to put new capital risk. I'm a bit more optimistic on the market only because I think the market's been valuation insensitive.
That's a good point.
When you and I grew up in the market, you as well.
Valuations mattered?
Valuation mattered. Now it
the good old days.
It doesn't matter at all. So it's purely
Is that because
momentum.
of AI? Are you saying that investors don't think it matters, or is there some other factor leading to valuations being less relevant?
It's not AI.
It's not AI. It's just you have a new cohort of investors that are used to markets only going up, and that may be the right thing to do. I mean, you want to stay invested. You don't want to trade markets. I'm happy to trade them because I've been doing it for so long. But the point is, what could derail the market, to your point, is I don't see the Fed easing in September.
Yeah, I don't either.
I don't see that happening.
So it's certainly not July then, like Christopher Waller is calling for the Fed to do. Christopher Waller, kind of highlighting his feeling that a cut should already happen, possibly in July. Do you make anything out of that Waller, who may also be a candidate to replace
I was just going to say that.
Right.
Is the person coming out and saying this?
Right. Consider the motivation, right? You always need to consider the motivation.
Yeah, consider motivations, like canceling Colbert. Yeah, it's the most watched show, but it's economic. Look, while everybody's auditioning now, so everybody's going to be talking about that's a reasonable prospect, and even some underdogs for all about, let's cut. But the numbers don't give you the opportunity. We are seeing cracks in inflation, meaning going higher. So without the tariffs coming in. So I really think the Fed's on hold right now, and I think what Trump's actually done is he's put Powell back on his heels a little bit, and he's probably more resistant to cutting, so he can keep the independence of the Fed. That's his interest. I think he's altruistic in that. So we'll see. But in the meantime, tariffs can hurt. Worsening economic data can hurt. and we'll see from there.
All right, Kevin, they got the softballs. I'm going to come over to you. Are we at the risk of a bubble? Michael Hartnett from Bank of America out with a note. A couple data points he's kind of spreading. Equal weight S&P versus the regular S&P at a 22-year low. Small caps versus the S&P at 25-year lows. Value versus growth at a 30-year low. In his mind, all signals U.S. economy is slowing and or U.S. equities are bubbling and we might be in a bubble. Your take?
Yeah, I don't see it as a bubble. 2023 was a better example of that microchasm where we really had 7 stocks and there was no breadth. Nothing else was doing any part of the heavy lifting. At least here, it's not just megatech. It's not just AI. We've got industrials. We've got financials weighing in. Well, I don't care about small caps.
To your point, though, the Mag 7, they're about half of the earnings growth for this quarter. So it's like 7 stocks doing a whole lot of the lifting.
And we need them to, because if they don't deliver on earnings, then you can forget the markets being higher on a broader index basis because they're delivering so much of the earnings. But I think that the bubble story is probably a little bit stretched at this point because I think the earnings will deliver, Frank.
All right. Let me just pause. Can I just point out the Netflix chart right now? I mean, let's take a look at the Netflix chart. Shares are down more than 4.5%. They beat on the top and bottom line, improved their outlook for the second half of the year, and this stock is still going low. Are we at risk as we see some of these mega cap tech names, and Jenny, feel free to jump in, that we could see the same setup, that a Microsoft, a Meta, an Amazon, they could beat expectations, give good guidance, and still move lower because it's just simply not good enough because, to your point, valuation, even though we have this, what you call a new cohort.
But I think that's the thing. What's Netflix down right now? 2%?
It was down 5%. But
yeah, but then I thought I saw it less. Whatever.
Down 4.7.
It's just not that much, right? So, and I think when we think about the valuations of the Mag 7 overall right now, I'll call them stretched a little. You know, they're not stretched a lot.
A little.
In the past, I've kind of freaked out by how stretched the valuations are, and that's just not the case. So for us, right, we have our disciplined growth strategy where it needs a 5% or better free cash flow yield to get in there. Like, Apple's on the short list. Google's kind of on the short list.
Meaning you're going to short it?
No, on the short list of potential things that we could buy. But the reason being, the cash flow's there, the valuations are reasonable. So when we look at the Mag 7, my thought collectively is, maybe they plateau, right? But I don't see that in frothy territory.
Look at it this way: the stock's doubled over the last year.
Which one?
Netflix.
So okay, sorry. Coming back to that. I thought you meant Mag 7.
So we're going to talk about it later. I'm just saying, is this an example of some of the risk that comes in earnings season, where a company does better than expected, they raise their guidance. Generally, that makes the stock move higher.
No, this is idiosyncratic, right? This is a story like no other story out there. Now, take your question a little further. If you see Google, Alphabet, if they miss because of cloud, and then Microsoft misses because of cloud, those factors, that's more of a market story, that growth, because that feeds into so many other elements of the market. But no, I don't think I think people are reasonable. And by the way, Netflix has sold off so many times on earnings that if you sold because of that, then you made a mistake. The 5% here is nothing. It's bupkis. It don't even focus on. But here's what I'd say. If you take a look at a number of the firms that came out and raised their price target in advance of it, and the money that piled in, and now to sell in the news from the traders that got in, they're getting out.
So everybody's feeling good. You're not worried about any froth in the market. In fact,
I'm not feeling good. I never feel good.
Me neither.
I always have concern.
You look
about
good,
the market.
I like the pocket square.
If you don't have concern and worry about risk in the market as professionals, if that's not your primary concern, then you shouldn't be in the business.
All right, let's touch on something really quick. This is an ETF I wasn't that familiar with before today. The Next Generation AI U.S. Sentiment Leader Index, the ticker's BUZZ. Note from BTIG's Krinsky saying he's seeing more and more signs of short-term froth in the market. He's pointing to this ETF up 45% in the last couple weeks, 29% above its 200-day moving average. And some of the top holdings are some of your holdings, Kevin, Robinhood and Palantir. Are you worried that there's a risk of unwinding in a lot of these names and that the momentum may be slowing down and possibly moving in the other direction? In all fairness, though, big gainers, similar to Weiss's point, these are stocks that have big run-ups, but worried about some of that momentum unwinding itself.
It would be very difficult if you think of a coiled spring for these not to give up something at some point, because if you look at Robinhood in particular, which is one of our favorite stocks in the growth portfolio, Frank, in early April, this thing was trading in the low 30s. and now I don't know where the chart is, but probably close to $110 a share.
Yeah,
I mean,
right
that is
there.
an incredible run, but I'm not ready to bet against it because they control the ecosystem of the young person. Roblox, American Express, Robinhood. We love these because of where they're embedded. Palantir a little bit different, but if you look at how they're expanding away from just being purely dedicated to government contracts, how they're getting to the private sector, I'm not going to be the person that's shorting these or betting against them, not yet.